Welcome back, everybody, to the Everything Real Estate Show. Today, I have my friend Ed Keck on the show with me, and buckle up because this is a wild conversation, and it starts with his career process where he started trading precious metals at 12 years old. You heard that right, 12 years old, buying his first real estate at age 16, getting his real estate license at 18, then becoming an industrial engineer, then getting into flipping and private mortgages and becoming a landlord, and then selling trees, and then selling everything, and getting into just buying dividend stocks. And man, oh man, is it a lot. And if there's a few key takeaways that I can leave you with, it's Ed's theory of using other people's money, considering what negative real interest rates are. So always taking a look at what the cost of borrowing money is versus what potential you can get out of it by investing in assets, and how that truly creates wealth. So there's a lot covered in this conversation. It is not investing advice. We definitely recommend seeking the advice of a professional before you make a move based on any of this conversation. But simply, it's Ed sharing his strategies and his experiences and his story that he's been building for the last 59 years. So I think you're going to enjoy it a lot. And anyways, buckle up again. My name is Cody Kraus, and I'm a real estate broker owner that's obsessed with everything real estate. Investing, building, selling, developing, farming, you name it. I've been doing this since I was 18 years old, and I've learned a ton through trial and error, and I've met some of the coolest people ever. This is a show where I invite these people on to talk about their experiences and mine, plus everything else real estate. Let's go. All right, well, welcome back, everybody, to the Everything Real Estate Show. Today I have with me Mr. Ed Keck. For anybody who doesn't know Ed, who is Ed?
Who is Ed? Well, I started off in real estate when I was 16. I bought my first property. It was a tax sale property, and from there I kind of kept buying and having lots of rental properties, and tried to do one of everything. Tried flipping properties. Tried mostly rentals. So it was kind of, I found that we bought them, we repaired them, and then we rented them out and refinanced, and that's how we kind of evolved.
So you invented the BRRRR strategy, right?
Well, yeah, someone came up with that, and I thought that was a pretty cool terminology. But no, that wasn't my term, but my philosophy, just not my term.
Yeah. And for anybody who doesn't know, that's buy, rehab, refinance, and then rent, right? So put your capital in, get it out, and the idea is you get all your money back, and then you go on to the next one.
And there's a lot of times that we came out with pulling cash out after we refinanced, and that kind of led to being able to keep going on other properties.
Cool. So we were talking beforehand, and you mentioned that your investing career actually started at age 12.
Well, yeah. Well, so friend of ours, and I always tried making money, whatever means that was.
Yeah.
You know, I always tried to come up with some method. But a friend of mine his father was trading precious metals, so I thought, man, how hard could that be? So, so that's how it all started. I started trading precious metals when I was 12.
Gold and silver mostly, or did you get into
no, just precious metals, mostly silver. And, it wasn't a career, so that didn't end all that well, but...
I heard a stat this week that if you tracked the price of gold in ounces versus average home sale price in Canada, that housing in Canada actually peaked in 2007. I don't know if it's true or not, but I heard that this week, so I'll have to look into it.
Gold's on a run.
Yeah. So started trading precious metals at 12 years old, bought your first property at 16. Now, you can't even transfer a house into your name at 16. So did you have to buy it and put it in dad's name?
No, I did. I bought a tax sale property, and it was basically, it wasn't. It was a vacant lot that I paid $1,013 for.
Yeah.
And I won the bid, and I transferred it, and that was it.
Okay. So then at 18 years old, you got your real estate license.
Right.
Now the goal was never to sell real estate full time.
Right.
And you ended up going to university, and you became an engineer.
Right.
What type of engineer was it?
Industrial
engineer. Okay. But you had your real estate license. Probably just piqued your interest having bought that land and then sold it?
Well, it was, my dad was in real estate. So, I thought, I always thought that investing was the way to go. And, I had this strategy, and it didn't work out all that well. But I said that if I could buy 10 units, I could generate about $1,000 a week after they were paid off. And I figured by the age of 40, I would be able to retire.
Yep.
So that was kind of always my goal, to retire at 40.
Well, and I mean, if you were buying them at 20 and putting 20-year mortgages on them.
And, you paid them down. And, I never thought of it as a cash flow. I always thought of it, this was going to be my retirement.
The Freedom 40 plan.
Yeah, the Freedom 40 plan, exactly.
Okay. So industrial engineer, and then somewhere around 2008, 2009, which was our big financial crisis, didn't affect a lot of Canada the way that it did Windsor, Essex County, but severely impacted Windsor, Essex because of how dependent we are on Detroit. And so when everyone else was scared of it, that's when you really started buying properties?
Yeah, well, we start, it was back in 2000, early 90s, really, is when we started buying a lot of property. And then it came to a point where my wife ended up retiring, or I shouldn't say retired. She took
transitioning to taking care of our properties.
And so that's what she did. She looked after the properties all those years, and so she did that, and we managed all the properties along the way, but in 08, 09, that was really when we came up with this theory of we'd be able to buy property, rehab it, and offer no money down deal where we would hold the second, people would get a new first, and we did that for probably about 15 properties, and probably at the end of it, I think we probably ended up losing about 10 or 11 seconds on it. They defaulted.
So the idea was maybe we can get a slightly higher price if we entice people with zero money down.
Yeah, exactly.
The only thing is we got to hold the second to get that price.
Right.
Okay.
Yeah, exactly.
So I said, you've met my dad before, and I said to my dad one time, I'm like, how come you didn't buy a whole bunch of farmland like 20 years ago? Because it used to be really cheap. And now you look around, like the average going rate for land right now kind of starts around $20,000 an acre. It could be, $16,000, $17,000 if it's clay without drainage, or you couldn't build on it. But not crazy to see stuff trade for $25,000 to $27,000 if it's sand and if it's buildable. And then if you have greenhouse land, well, sky's the limit, right? We've seen stuff trade anywhere from $50,000 to $100,000 an acre. If it's flat, square, you have the utilities in place, all that kind of stuff. But he said, Cody, farms were for sale for the same price for forever. They never went up in value. They were for sale for years. Banks didn't want to lend on them. So it's easy to look back now because you've seen them appreciate over the last 20 years. But he goes, take out the last 2 decades, they never went up in value. And that was probably similar to you buying properties from the 90s all the way to the early 2010s, right?
Yeah. Well, yeah, it's always the in the rearview mirror. Why didn't I buy more? It's very easy to look back in the rearview mirror, but when you're in it and here's the stats that you see, farmland isn't going up, housing, there were a lot of points where house prices were going down.
Yeah. Now you have a saying, and it's time heals. Yeah. And so you gave me the example of a duplex that you had in Windsor. And do you want to maybe talk to that one a little bit?
Well, it truly, time does heal. So in 1996, we purchased a duplex, and it was cash flow positive, everything. It was a power sale when we bought it, so we thought we did very well on it. Paid $96,000 for it. Fast forward to 2008, 2009, so 12, 13 years later, that property was probably worth about 60.
Yeah.
But, it was still cash flowing, but that's just the reality. But at the end of it, when we ended up selling it, I believe in 2018, so what was that, 22 years later, we ended up selling it for $215. So, once again, time does heal.
Yeah. So you doubled your money on the appreciation.
Yeah.
But you also had 22 years of positive cash flow.
Absolutely.
And you probably refinanced it a few times in the meantime to borrow against it. And
our first place was on Lincoln.
Yeah.
Our first duplex. And I think I must have refinanced that thing about 7 times.
Okay. And then the other time heals example you gave was Manulife.
Oh, yeah. Yeah. So in about 2001, I changed jobs, and I had a little bit of a pension. So it was tied up into a lira. And I remember I really wasn't big on stocks. I had my RSPs and, but I was heavily investing in real estate. So there was no money left over for stocks. And so, I was watching BNN and I figured that, they would be able to tell me what the best stock to buy. So they said, and there was like, guest after guest kept saying, buy Manulife.
Jim Cramer. Yeah.
Like if you're not going to buy Manulife, you're truly not a very intelligent person. I'm like, well, geez, I don't
want to be dumb.
So then I bought it. I bought it for like $20.
Yeah.
And like a year later, it was worth 10. So I put it on DRIP. So that's a dividend reinvestment plan. And so all the dividends just kept buying more Manulife. And I just kind of walked away from it, not really paying too close attention. And over the years, I added some stocks, shuffled a few things around, but today that stock, so about 24 years later, is up 700%. And, once again, it's that whole thing about time and time heals.
So if we took 700 divided by, you said 28 years?
Yeah, or 20, it was 24 years.
So it ended up being like mid-teens on an annualized basis?
I don't know if it was quite that high, but yeah, if you do the double, so it'd probably be maybe like 10, 12.
Yeah. Wow. Now, back to your duplex example, you said that you probably refinanced it like 15 times. So that kind of leads into one of your other theories, which is Robert Kiyosaki thing too, right?
Yep.
Rich Dad, Poor
Yep.
Dad, OPM. Do you want to speak to
Yeah,
that a
and
little
I think
bit?
everybody understands this one, right? I think everybody and their brother has read the book Rich Dad, Poor Dad.
Yeah.
But one of the things I always take away from that is I call it Operation Government. And
Okay.
truly nothing political here. I won't get into politics, but it's truly. Let me ask you, like anywhere in the world, any government. Does any government ever think about paying down their debt?
Not aware of one.
No, they're all increasing their debt. And in fact, we don't talk about our debt anymore. Whatever Canada's debt is now, 1.2 trillion or whatever that number is, we're all looking at debt to GDP.
Yeah.
And
So we're not necessarily looking at paying down our loan. We're like, well, if we can just out earn it, we'll make the loan look smaller.
Out-earn it and inflation it out.
Yeah.
So it's the same philosophy if you buy a house and you amortize it for 25 years and really what you're looking for is a lot of inflation, appreciation, inflation.
Yeah. And if you just make more money proportionately, your mortgage payments look smaller.
Yeah, well, rents go up and all that good stuff, and your property appreciates because inflation. And over time, it works. But the way I look at it, and it's not for everybody because you got to be able to sleep at night, but for me, it's the true key. If I step back to the true key to financial wealth is margins and mortgages and borrowing money. And to this day, I still margin our stocks. And
so just leverage real assets and you'll be the one that benefits from inflation.
Right. And, it's once again, there isn't a government in the world that's looking at paying down their debt. Why should you?
Well, and to your point, like without getting political, but we can still use our two leaders right now. So Donald Trump sells himself as a business person, right? He's not talking about paying down the debt that's there. In fact, I've heard that their payments on interest in the States has actually exceeded their defense spending.
Right.
That's
right.
And they're not talking about paying it down.
Right.
We have very much a liberal government in Canada, Carney, so total opposite side of the coin, right? And Chrystia Freeland stepped down when she was tasked with presenting their $62 billion deficit in 2024, which was supposed to be $42 billion. So they went over by 50%. And she's like, I got scapegoated to present this. And this is your problem, JT. Yeah. Carney's already talking about running $90 million if they can present a budget. So yeah, liberal government, conservative government, Democrat, Republican, nobody's talking about making that debt smaller.
Right. And how else do you get true torque to your investment? Like if you can borrow at and I'll use my margin account through Interactive Broker I'm paying 3.5% interest. If I can borrow a dividend stock that pays 5.5%, I've got 2% positive cash flow. That's without growth. And granted,
And without writing off the interest cost.
what
And
in your interest, like at the high tax bracket, you're going to get back half of that 3.5%, and your 5.5%, you're going to get your dividend tax credits. So you have a pretty good return. And then if you look at just even adding 3 or 4% growth onto your stock, now you're up to 7-8%. But what's your ROE? You have no equity in it, right? This is just strictly mortgaged money or margin money.
so you're looking at mostly Canadian dividend
Yes.
companies that have a 5-decade plus span of paying dividends at 5 to 8% or whatever.
Exactly. Like even if you look at the kings of dividend increasers like a Fortis that have paid out or increased their dividends, not kept their dividends, but actually increased their dividends for 52 straight years. Wow. So it's not cutting it, it's not keeping it the same, it's increasing their dividends.
Yeah,
and 52 years.
And if it appreciates, it's icing on the cake.
And it does.
Yeah, because everybody's like, well, I want a piece of that. If they're always increasing their dividend.
But if you think about it, if it didn't, your dividend would be like 100% in 30 years. So obviously your stock's going to go up.
Yeah, yeah. So we just gave the example of other people's money on stocks. So if it's paying a 7% dividend, cost of borrowing is 3%, there's a 4% spread. Why wouldn't you take it? Well, it's the risk. But if they've got a 5-decade or a 10-decade, track record, it gives you pretty good safety. Now, the other side of that, obviously, is real estate, and that's what you built your rental portfolio based off of, and your whole theory going, well, the bank's going to give me 80% of this, say, $100,000 house, so I just got to come up with 20 plus closing costs. Or if I do the Burr method, I might buy it for 100, put in 20, make it worth 140, pull out my cash investment, own the asset. Now, like you said, no equity in it, similar to your position in the stocks because it's mostly levered. But now I still benefit from the ownership of the asset long term. We're not talking about flipping it in a year and making a ton of money in 1 year. To give your duplex example, it's 22 years to benefit the 100% increase.
Yeah, exactly. But even if you look at it and said, okay, so I'm going to go 5 years out. So I buy a property. And after 5 years, you have a little bit of principal that you've paid off, and hopefully it's appreciated. So now you go to refinance after your 5-year term is done, and you pull out your equity. And then you take that equity and you go buy your next one. So if you bought even one a year for 5 years, and then you just keep flipping out your equity.
I know a gentleman, and his theory was, well, when I retire, if I can have 10 properties, I'll just live off of refinancing one every year.
Yeah.
It's tax-free money. And you figure even if they didn't appreciate, as long as the cash flow was there, that it covered the cost of ownership and the maintenance and everything like that, it's not crazy to think that there's going to be a little bit of appreciation over a decade. But even if there isn't, there's a lot of principal pay down that happens over 10 years.
But even take it a step further. Like, so in 10 years from now, do you think the $1 is still worth $1?
No, not even close.
Once again, it's inflation.
Yeah.
Inflation just will eat that rate up.
So
why wouldn't you?
Our kids drink these yogurt drinks, and they're ridiculous. We have 4 kids, and they probably go through a case of these every 2-3 days. And like pre-COVID 2020, right before there, I think they were $7.99 or $9.99 a case. Then all of a sudden they were $14 a case. Then all of a sudden they're $17 a case. And all of a sudden they're $19.99. Every now and then you catch them on sale for $16. It's like, okay, well, as a North American family, my cost of just buying that one product has gone up 100% in basically 5 years. Well, has the average family's income gone up 100%? And well, actually, it needs to go up more than that to cover the difference, because now you're paying more income tax on it to then buy that same product too. So your whole theory is be on the other side of inflation, where you buy the stuff that benefits from it. And
that's the unfortunate thing too. Like I remember a friend of mine. He said inflation was good, and the media just programs you to say, oh no, inflation's bad. You got to take inflation out. If you have assets, your inflation is a good thing.
Yeah.
And it's very unfortunate though that it creates a division of wealth.
It spreads the gap like crazy.
It does,
Yeah.
and that's a huge problem. So if you don't have assets, so you've done well, but once again, take the average family that now that case of your yogurt is $19.99. Like there's no way that their wages have gone up that much.
No, no. And the trick that everybody falls into too is, oh, great. I got a raise at work, or minimum wage went up to this.
Yeah.
But
So then just up, I'm going to go buy a boat. I'm going to go.
well, now you're in a higher tax bracket, right? And so even though, okay, well, maybe you're making extra $10,000 a year in theory, great, but you might be paying an extra, maybe your tax rate was already 30%. Maybe now it averages out around 35 with that increase or whatever. So you're not truly $10,000 more. You might actually only be $6,500 or something like that. But if in the meantime everything else inflates, well, now I'm using 65% money instead of 70% money to buy something that's gone from $10 to $17 or $10 to $20. Well, now all of a sudden the raise doesn't look that great because the actual retained dollar at the end of it. And don't forget in Ontario, 13% HST. So the product inflates. Then the government's got a ratcheted, tax on top of that too. Well, so everything just got really expensive. I didn't actually make that much more money. Like take home at the end of the day might even be less, unless I own more than just my house or just my stock portfolio and then benefit from the inflation.
And that's where you can add the extra torque. It's once again, you go buy that rental property, go margin your stocks. But once again, you have to be able to sleep at night, and it's just not for everybody, but it's truly is what I feel is the key.
Yeah. And I mean, when you were in it, when you were starting it at the beginning, probably everybody thought you're nuts.
Oh,
why are you borrowing this much money? You're going into debt. What if the market turns down? Like everybody thought you're crazy because it's like, well, Ed, it's great borrowing money when everything's appreciating and it's on the way up, but levers work both ways, right? So you obviously put fail safes and safety measures in place too.
There was a ton of analysis. I'm very analytical, so it was like, what's my sensitivity analysis? So if my rents go down, or if I can't fill the vacancy, what would be the minimum amount of rent that I would need to cover my mortgage? And so I would do a ton of those analyses, and it's a lot simpler with dividend stocks. But with rentals, it's once again, there's just more variables.
Yeah. So 2008, started picking up a bunch of properties, and we were rehabbing them and then selling them zero down, selling seconds on them. Got away from that. I think at one point you told me you were buying like a house a week.
Well, a house about every 3 weeks, yeah.
Every 3 weeks.
Every 3-4 weeks. We would put offers in, probably 5 or 6 offers almost every day. And it's hard to imagine it. You can just drive down a road, and it'll be like every third house was for sale.
Yeah.
And it's like we were just talking about, like, well, it's so simple. Like, why wouldn't you go out and buy a whole pile of them? Well, it's once again, houses were $60,000 to $70,000. Your rents were $600, and you were doing okay. Good cap rates, but once again, where was the bottom?
Yeah.
And you really had to kind of go against the grain because, there was a lot of people thinking it was crazy. But more so right when I got out of school, like when I got out of university, there was I wanted to keep buying real estate. And I had a lot of friends and relatives just basically saying that, it's crazy. Like, what are you doing? Like, you're going to go under. So, you had a lot of that in play, but you have to be strong enough to understand that it was a good thing.
Now, with an engineer's mindset, like typically it's very analytical and it's not a whole lot of emotion. It's a lot more logic, right? So like you said, you analyzed it and you put in a lot of, your appetite for risk and all that kind of stuff. But I have found that there's certain people that are, naturally they fit into certain careers. And a lot of times it's because of their ability to I guess, focus on that mindset. So we personality profile at our company. And so one personality profile is called a green earth. And if you had to like pick the mascot career for that profile, it's an engineer, and it's their ability to look at logic and not necessarily emotion. So what systems are we putting in place? What is the potential of failure? Like okay, well, if our potential benefits or likely benefits can, at least exceed our potential downside, like a lot of people would look at it and go, okay, well, what if I get no rent? And you're going, well, no, what price would I have to lower my rent
Exactly.
to be a minimum, right? So it's not, well, I'll carry it empty for a year. It's like, well, no, if I decrease my rent from $1,000 to 500, there's going to be someone
Exactly.
in there. So it's not all or nothing. It's let's build out a system, and if the system works, we'll buy the house. And that's why you're making 5, 6 offers a day. When there's that many to choose from, you could say, well, at this price, it would make sense. So, I might write 25, 30, 60 offers. And if I get one or two,
Right.
they were smoking deals where the numbers just made sense. Good market, bad market, this one's going to work.
Right. Right. And there it was also, we went through, we started off with a semi, and then we bought a duplexes, and then we went from duplexes to 4 units. And then from 4 units, we started into multi-res, like 11 unit, 27 units. And then when we got up to like a 27 unit, we were thinking, well, you can go really big. But then it was always the issue of like, you would have one bad tenant in a 27 unit building. Now everybody's moving.
Yeah.
So then, then we said, well, reverse all that. And we had an 18 unit, we sold it and started just buying single family properties. And we got up to about 34 single family houses. And then it was like, man, there was a lot of roofs and a lot of furnaces. And then when people move out, now you have to rehab a house. And it's not like we used to, it used to work out to about every 25 months, I believe, is when the average tenant would just rotate out. So when you have 100 plus units, it's a full-time job.
You're turning 4 people a month.
Yeah. So
Yeah, and
it's a
the
job.
other thing too is like the multifamily, the cash flow can be great, and yeah, you're maintaining one building instead of 25 buildings or whatever. But also on the appreciation side of it, there's only so many people that are buying a 25 unit building, and emotion doesn't really play into the pricing or the value. My whole thing is if I could buy single family homes that would carry themselves, even if they weren't super cash flow positive, if the market's starting to appreciate, up to 5% of the price can be emotion when you're selling to the end user, right? Because now it's, I really need to be in this school district. The investor doesn't care as much about the school district, but the family that's going to live there as a primary residence absolutely does. So when you're selling your investment to the end user, you can really benefit from more appreciation on the emotional side of it there. For investors, it's usually just about dollars and cents.
Yeah.
It maths or it doesn't.
But even on multi-res, it becomes a lot more complex. It really, it's try to finance. The financing is a lot more difficult
And more expensive.
and more expensive. And there was it was a bit of a roller coaster there too. There were certain institutions that would, as long as you had CMHC, they would finance with a little better rates, but it was a lot harder to finance just the being able to get the financing was a lot more difficult because there was a lot more red tape, and it's just a different game, and it may sound like that's the progression that you do, and then once again we went down to just single families, along with so we kept our multi-res, but it was then to a point where that didn't make sense. So then we started going back to like an 11 unit and we
It's like small multis.
yeah and once again I don't know what the right answer is. There's pluses and minuses to each, but
It's maybe diversity. Maybe that's the right answer. Is
yeah,
benefit from
it's there's no easy road either way.
yeah. Now I'm trying to think of what I was going to ask, but I'll ask this instead. So you built up this very large rental portfolio, and obviously got to the point where Laura doesn't make sense to have your full-time job anymore, be the property manager, and then you had to make a decision at some point too to probably retire from being an engineer and go, we got a lot of property here. We got to work on these things, manage everything. And of course you can hire management companies, you can hire general contractors, but you obviously want to keep costs under control and make sure that things are getting done proactively. And then there's the showing the properties, getting them rented out. And then, well, who's building the portfolio if I'm at work? And it's always scaling to be more. Now, you'd mentioned to me that one time you were sitting under a tree in your backyard and you kind of just had this aha moment and you decided to start selling all your property basically.
Yeah, it was to a point in about 2018, 19, we really wanted to step back. And it was kind of something that I always address as what I refer to as enough. When you have enough, you have enough, and probably didn't realize that until later in life. But in the 2018, 19, it was just a step back. It was crazy. It was I saw the cap rates collapsing. We stopped buying.
That's because properties were getting so expensive.
That's exactly right. So it was just you couldn't catch it. Really, in 2015, and I know this might sound a little ridiculous, but when cap rates fell below 7-8%, I just didn't think it was worth it. And that was when mortgage rates were at, say, 4. That delta I was just the interest rate differential just wasn't there enough to cope with the work that you had to do to put into the rental. So we started selling, and probably missed the big bubble. We ended up kind of depleting in 2021 when we sold an 11 unit. That was kind of our last building that we sold. But
I don't know if you could have timed it much better because a lot of the stuff that sold in 22 didn't end up closing either.
Yeah. Well, we ended up selling from 2018 to 2021. It was 38 buildings that we sold, and it was pretty hectic.
No kidding. But no, that's the period that you should have done it, because really the first double-digit gains that Windsor Essex ever saw in real estate prices, at least since I was in the business, was 2016. It went up 12.8%. 2017 went up 17.2%.
Wow.
The GTA actually had a 30% decrease in 2018. We still had an increase in Windsor Essex because people had seen like crazy price appreciation in Toronto, and they were like, average home price in Windsor is like $200,000, $300,000 versus maybe it was $800,000, $850,000 in Toronto at the time. So, I mean, you benefited from 2017, 16, 17, and a lot of them even into 18, 19, and 20. And like those are, if historically, like the largest decade of price growth that we've ever seen. Not even just in this area, but period.
And then when you ran into 2020 during COVID, like there isn't anybody, I'd call BS on it if someone said that they think that the real estate prices were going to skyrocket in 2020. Like,
no, that's why the government actually kept decreasing interest rates then, right?
And it was crazy. But one of the last houses we sold in it was September of 2020, and we completely rehabbed this place. It was a 4-bedroom, 1-bath. We went in and we completely gutted it. We were right down to the studs, new flooring, new bath, granite countertops, kitchen, windows, painted the outside, new deck. Like we just did everything to this house, and we ended up getting $300,000 for it. About a year and a half later, this person came over for trees, and it was a realtor. She says, "Oh, we sold that house again that you rehabbed on Forest." I said, and I shouldn't have asked. I said, "Well, how much did you get?" And she goes, $550. And I said, and she's showing me these pictures. She go, "But they redid the deck." I'm going, "No,
like,
they didn't do
all that work.
I did all that. So it went from 300 to 550 in a year and a half.
But I mean, shoulda, coulda, woulda, right?
Exactly. Yeah. It's still, once again, very blessed and very fortunate. But you just hear those stories and you're like, yeah, complete insanity.
So my mentor, Tim, he would always say, "Yeah, but you didn't do nothing with the money." Right. So it's like, well, maybe I could have benefited for an extra 150 if I held on for a year. Yeah. But A, you didn't know it was going to go up. B, you took that money and did something else with it that was probably productive. And C, would you have just kept the house empty for a year and a half and be like, "Yep, I think this is the peak. I'll sell it now." Right. No, you would have rented it out. Well, maybe you wouldn't have been able to sell it tenanted, or maybe your tenant would have wrecked it. Right. Because that was also the time period too, where the landlord tenant board, it got out to,
that's right,
your applications for non-payment of rent, an M4, we had some that took 16 months. Like it was unreal. Doug Ford came out and said, "You know what? No new evictions because of COVID." And people took that as, I don't have to pay my rent, which is not what he meant, but that's how they wanted to understand it. And Therefore, everything got backlogged like crazy, right? So it's like, yeah, I could have got more, but I still did something, and I did something with the money in the meantime too, and I'm sure you benefited from that
it
too.
was a huge crash in the stock market, if you recall.
Yeah.
So we took our money that, you worked all your life for in 2018, 19, we're selling the property, so then you put it into the stock market. And the stock market, it lost what I recall, it was like a March, April time frame. And what I recall, it was like 35%. So you just took all your money, then you paid an enormous tax bill.
Yeah.
And then you ended up losing in 2 months 35% or whatever
Yeah.
it was. So
Now that was 2020. Now, if we looked at the stock market between now and 2025,
Right.
so to your quote of time heals, if I held all those same stocks from 2020 to 25,
right,
turned out okay.
absolutely. Like I think in my personal portfolio, it went from 2022 was a negative 8%, but in 2024 it went up 27%.
Yeah.
So big fluctuations, and I think your point about in 2022 when interest rates spiked. Well, I generally invest my stocks into Canadian dividend-paying stocks, so they act more as a bond proxy. So guess what happens when interest rates go up?
So does your
Those go down.
Yeah.
Because people are like, well, I can go and get a GIC for 5.5–6%. Why would I buy stocks? So then the stocks just fell off a cliff and then recovered.
Yeah. Yeah. So if I can pull a lesson from that, it's you were quoting Warren Buffett earlier too, which is be greedy when everybody else is scared and scared when everyone else is greedy, right? So 2008, you started buying properties when everybody else was scared. You got greedy then, rode that wave until, 10 years later, 12 years later, obviously you saw the benefit there. Now it would have been really scary. Like you said, you got to pay the capital gains tax. Then I'm putting all the money into stocks. Then the stock market crashes. What did I do? Should I sell all my stocks now and go back into the real estate market?
Yeah.
Well, no, if we're just patient, maybe even buy more when things are down right now, then we could actually benefit from holding it over a long period of time. So let's not look at it as a 1 week window or a 52-week window or a 5-year window. Let's look at the long term. And that's why even when you're looking at your dividend stocks, you want to see track records of multi-decades, right?
Yeah, and there it was more of, I always said about your dividends are well covered, and that's going to cover your interest rates. But so in 2022, it was the same type of thing that happened in 2008 with Canadian dividend stocks. It became so cheap, like I think I was referring to CIBC. It had like a 7.5% dividend rate. Like it was just insane.
You said it was like $48.
$48, yeah. So today that stock is just closed, I believe, at like $98. So this is, I simply investing in outside of my TFSAs and RSPs. It's simply just
Canadian
dividends because I get my Canadian dividend tax credit.
Yeah. And do you like the single stocks, or do you like a fund based on this type of stock?
Well, the simple thing to do is to buy the index. And so I do that. I buy a lot of the index, but generally speaking, it's the TSX 60. And there's a great little strategy out there where an individual did this back testing, and you take the TSX 60, so the 60 highest by cap rate, so your largest stocks and the TSX, you then rank them to the highest dividends, and you buy the top 10.
And it's dividend, like it's not the price of the dividend. It's not $10. It's versus the cost of the stock too, right?
It's a percent. So so what you do is you take your highest dividend rate, you buy the top 10 out of the TSX 60.
Okay.
And that's what you invest in. And then once a year, you readjust your portfolio to whatever are the highest 10 paying as a dividend percentage. And back tested for the last 30 years, it returns almost 13%.
Wow. And then again, you might borrow at 3%, or in 2023, it might have been 6%. But
Right. Yeah. And once again, so just on a cash flow positive, like even today, once again, you borrow at 3.5 and you buy a stock at 5.5. So, you're cash flow positive. You write off your interest. But, once again, there's all the growth that you're not even accounting for.
Yeah. And just like real estate benefited from inflation, stocks are benefiting from inflation too.
Yeah,
Because
it's an asset.
naturally there's more financial activity in the market when debt's going really high and the government's printing money to try and offset the debt.
Yeah, you just once again, you let inflation kind of rule that. You add your torque to either a mortgage or a margin.
Okay. Unrelated, you had a tree business too. So we did real estate. Now we started transitioning, real estate to stocks and all that kind of stuff. And you had a big property and you wanted to plant some cedars around your pond. And that ended up turning into a business on its own too.
Yeah, that one, it started off kind of as a hobby. And then we actually grew it to, fairly good business. My son started it. As soon as he started it, we ended up wanting to sell. So
Yeah.
so he kind of got left with a few trees left behind. But yeah, it was just a cool thing. It ended up being taken off a little bit better than what we anticipated, and which was a good thing.
Yeah. So it seems like any business that you've got into, not that they were by mistake, but you've always analyzed it and then taken a niche approach to it, right? So, yeah, well, we just wanted trees, but then we realized that if you go buy mature trees or even like teenager trees, I don't know if that's the right way to say it or whatever, but 2, 3, 4-year-old saplings versus like seedlings are next to nothing, right? And to actually buy, and if you're buying them in scale, and well, then all we got to do is plant them. So if we have land and water and fertilizer, we can make them pretty big pretty quick. Then all of a sudden, they're not cents per seedling; they're dollars per sapling, and usually more than 10, right?
Yeah. Yeah. No, we ended up selling thousands of trees a year, and it ended up, once again, pretty good business. Some hard work, but it was good for the kids to get out there and dig some trees, and
Yeah,
it was a family event.
love it. Okay, so we've talked about everything from kind of your career start and evolution, and it's precious metals, bought property at 16 years old, vacant land, real estate license, industrial engineer. Then we got into rehabbing properties and giving seconds. And then we just grew the rental portfolio and apartments. Then we scaled back to single family, and then we went back to small apartments. And then we decided just to sell it all and really go into stocks. What's next?
Well, we do have 28 units left, so they were probably going to divest from that. That's going to happen, I think, relatively quickly. That we'll be completely out of the rental business, and it's just, once again, I'm 59 now, so it's that the thought of enough.
Yeah.
And you truly it's a fabulous building. It's basically a seniors building, and great tenants, but once again, it's just why. And so we came to that thought a few weeks ago, and we're just kind of in the process of kind of cleaning it up, and we'll probably put that up relatively quickly and be completely out. That era will be done, and there it will be complete divesting away from Canada. So it will be an ETF that would just cover global stocks outside of Canada. So not Canada at all.
So
that's kind of the
diversified, I guess you're not diversifying the holdings in one sense where it's different asset classes, but you're going, okay, I've been building this dividend portfolio based on Canadian stocks,
Right.
but now I need some exposure of my net worth to what's going on globally rather than just in Canada.
Right. So the dividends have completely replaced our rental income and then some. So then you just get to a point where you have enough income. So then you don't even want. So once you get past a certain percentage or a certain amount of dividends, your credits don't work out as well.
They don't go as far. Yeah.
So really you don't want it, because your best tax advantage is capital gains. So what you want to do is you want to have very little dividends, and you also want diversification. Because once again, I've always believed in multiple streams of income, be it trees, and I've got several other businesses that I had, and the rental properties. And you always had this diversification, multiple streams of income. So now it's basically that's done.
Yeah.
So if you sell the 27 unit, there's actually just one house left.
Yeah.
So then it's basically all the income will be coming from dividends. So then once you have enough, then you turn around and say, I really should diversify. And that's where there's lots of ETFs out there that will just do a global portfolio
Yeah.
outside of Canada.
Now, I mean, that's diversification right there because, okay, yeah, it's a stock asset, but now we're dealing with different countries. I guess one question I have is, how do you feel that Canada's markets are going to hold up against the globes? Like, I would imagine getting into a globally traded fund, like, I mean, naturally, we're always looking at the States. The States is a country of 350, 360 million, but obviously finances are incredible on a per capita basis.
Right.
But I mean, we're not getting exposure to India and China, which are
Right.
over 1 billion people each. And
Right. And it's certainly not the market cap of where the stock market is. Generally, it is the U.S. And Canada is only 3% of the global market. And when you hold so much into Canadian dividends, because once again, the tax credits are there. Once you start receiving dividends outside of Canada, it's taxed just like interest or any other income.
Yeah.
So, as a certainly not a tax advisor, but I do know from my personal experience that's the worst tax bracket you want to be in.
Yeah. Now, also, like our currency moves differently
Right.
depending on what's going on, tariffs, what our actual GDP is, our debt, all that kind of stuff. Do you think that there's benefit to having holdings in other currencies? Like USD is probably the biggest one, but Germany's got a pretty big stock exchange where you're working with euros there too, and then Japan and Australia. Like, does it make sense to hold other currencies too, or would you still?
Well, when you hold like an ETF, for example, it's called VXC, which is a Vanguard product that basically is outside of Canada, but it holds the global market. So you're going to basically hold all those currencies.
Okay, so you would own the proportionate amount of that stock
Exactly.
in that currency.
Even though that, and I don't know the exact percentage, but it's like 50% would be the in the U.S. because that's just where all the market cap is.
Yeah.
But it's basically all the stock markets in the world. So it's a global fund which will compensate for your different currencies.
Yeah. Okay. So I mean, a few themes that I can kind of pull from this interview is number one, don't be scared to cut against the grain a little bit, right? If everybody else is running this way, I'm going to go see what they're running from. I'm not just going to follow them.
Which is the hardest thing to do.
Yeah.
It's so easily said, like, everybody's sitting there like your dad, well, why didn't you go buy more farmland? Well, it's once again, well, it's tough to do. It's tough to go out when every third house is for sale in Windsor and you're driving down the street going, okay, that one's for sale, that one's for sale, I'm going to go buy. Now I'm going to be the investor, and I'm going to go in, and I'm going to put everything on the line, and I'm going to go buy all this real estate when everybody else is running out.
Yeah.
It's the same thing with the stock market. Like I said, in 2022, that was really where we came to that revelation that dividend stocks were just so cheap, and that's where we really heavily margined into buying in 2022, which ended up paying off. And it was just basically common sense that, a dividend stock, like for instance, CIBC was paying a 7.5% dividend, which makes no sense in
When your
history.
cost of borrowing is less than half of that.
Well, no, because then the cost of borrowing was higher. It was like 6.5%.
Yeah, if it was the tail end of 22.
But
yeah.
it was, and your margin rates were relatively high, so, but it's still, if you look back at that time, and you said, would interest rates go up? Like at that point, if interest rates would have went up further in 2022, the refinancing, when people would go refinance, you would just have a catastrophic failure in the real estate market. So the bond rates had to come down, and interest rates had to come down, mortgage rates had to come down. So to me, there was a lot of common sense that it had to correct. And, interest rates came down, and then that differential grew. So stock prices went up, so your dividend rates, in fact, went down just because a dividend is paid on an absolute basis, not a percentage.
Yeah.
The percentage is just a term that we use. So in other words, if you buy a stock that has $5 at a $50 stock, if the stock goes up to $100, you're still only paying $5. So
Your dividend yields
yeah,
half.
exactly. Your dividend yield just got cut in half, but the stock's still paying the $5.
Yeah. So it's your cost of acquisition, not
Yeah.
But then you readjust your portfolio according to that top 10 shuffle that you were talking about again.
Yeah. I don't necessarily use that strategy. I'm more of a buy and hold guy. Like I completely divested out of REITs, at the time I did a little analysis, and I went back to 2015 to 2024 at the time, and it showed that REITs just never increased their payout ratios. So in other words, they just didn't increase their dividends.
Is that
So
because
there's
their
no
operation
dividend growth.
costs grew with inflation, so therefore less profitability unless the rents went up accordingly?
Yeah, well, for whatever reason, they just have not increased their distributions. So if you go back and at the time I was holding about 15 REITs, and it was probably about 15% of my portfolio. I just looked at this and said, this is ridiculous. And then I overlaid it to utilities or banks or pipelines, and their dividends were like, in that same period, were going up somewhere between 50 and 100%, whereas REITs didn't move. I had one REIT, Canadian Apartment REIT, was the only REIT that increased its distribution out of all the REITs I held. And then they were outside of my sheltered accounts like TFSAs and RSPs. So I was paying a huge income tax rate because they're .UNs. So they don't get the Canadian dividend tax credits.
Preferential treatment. Yeah. So one was buy when everyone else is selling. Don't just follow the crowd. Another one is use other people's money and not just take on debt for the sake of taking on debt, because levers do work both ways. So if we don't have the ability to service the cash flow, then, well, that could have obviously a huge negative effect too. But you always want people to look at what is the cost of borrowing and what is the return I can get from that? What's the spread in between
The
them?
delta I.
Because debt can always make sense if the money that I can earn from that is significantly higher.
Yep.
Now, next question I have to follow that is, who teaches you that?
Well, it's trial
Right, so
and
you
error.
went to school to be an engineer. I don't think your elementary school and your high school teachers taught you all these lessons. If you talk to a lot of accountants and they're gonna be like, you're crazy. Just build your RSPs, build your TFSAs, put away the rest, and then retire early. But you're going, well, no, I mean, I don't want to be broke in my retirement, and I see what's happening with inflation. Unless I'm, buying more assets that benefit from this inflation, then retirement ain't looking great. So who taught you all that, or is it just self-taught, looking at it analytically?
Well, today I think there's a lot more resources. Like you can go on YouTube or just Google almost anything.
Yeah.
But we really didn't have those resources, so I read a lot of books. It was a lot of trial and error, and a lot of it I kind of stumbled into. It's not like when we started buying more real estate. Soon as my wife left work, then it was, well, I got to increase my portfolio. So then it was,
Because now I got to cover her income with more
right,
cash
exactly.
flow.
So that's how that kind of transpired. And even this margin, like I would have never thought of doing a margin. So it's not like I had this plan and I said, okay, I'm going to go sell my rental properties. And I sold a lot of rental properties, but I carried some first mortgages. So that was the stream of income that I had. And at the time, I was lending at 4%, thinking, well, this is a really good rate. And I have this income stream coming in. And suddenly in 2021, it was just like all the first mortgages were going, here's your money back. I can now go get 2.8%.
Yeah.
So now I'm like, oh, wow, now I've got all this money. Now what do I do? So then I was taking HELOCs and kind of just bridging when I knew this money was going to come, because I didn't want to put all the money into the stock market all at once.
No, you want to time average it.
Yeah, so then I was doing this HELOC. So really the margin thing never happened out of like, oh, I've got a big chalkboard there and I'm sitting there saying, okay, well, I've got this money and now I can margin and I can use this delta I and I can create all this extra income.
So this is something you kind of realized because you had money coming in and you said, I don't want it all to go into the stock market at once. If it goes down, then obviously it gets devalued according to that drop. But if it's going down, I still want to interject money so that at least I can average the cost there. And if it starts going back up, great. And I still want to cost average it on the way up. So
Right.
your whole thought was consistency in how much I'm buying.
Right.
And then you kind of stumbled into, well, hang on, all of a sudden my cost of borrowing might be 4% and my dividend yields are 8%. Why wouldn't I just borrow everything I can?
And why wouldn't I just, like, once again, Operation Government? Why would I pay that debt off? In 2022, I held a mortgage. And so I'm sitting there going, I'm just going to bridge this with this huge margin loan. And but then I started thinking, like, okay, so now when the money started coming in from the mortgage, I was like, why would I pay it off? I'm just going to go borrow more, because I saw this big opportunity in dividends. So that's, once again, I'd like to say I had this ingenious plan all the way along, but it's not how it worked out. And it's
No, you stumbled into it, but you looked at it critically and said, what's the opportunity?
yeah, even right out of the gate, I said that if I just had 10 units and I could get $500 a month, that's $1,000 a week. I can retire at the age of 40.
Yeah.
That was how that all kind of evolved. And then obviously, life
happened.
it really wasn't going to work out at this $500 or $1,000 a week. It just wasn't going to work out. So then we just started buying more, but there was no grandiose scheme at the age of 20. Okay, this is what I'm going to do, and like I said, even with the margin loan, when you have more time to sit down and kind of analyze. And, it was always kind of running around. I worked probably 60 hours a week at work. We had 100 rental units. We had a tree business. We had a couple other businesses. Like, it was just like, a couple kids. There was just not a lot of time to sit back and say, what's the next step? So really, in the last few years where, I've had a lot more time to think, it's really this whole concept of borrowing just makes so much sense to me, and I don't think I'll ever not owe money, because once again, that delta I, as long as it's there, like, why wouldn't you? Like, if let's say fast forward 25 years from now, why would I not hold that money that I just borrowed today to go buy a stock? Why would I pay it back?
Yeah.
Because it's paying itself. The stock's going to appreciate, and let inflation, let Operation Government, let inflation eat away at my debt. Because even if inflation goes up 3%, am I not paying my debt off 3% a year?
Well, and it's like a lot of this conversation is probably going to go over people's heads, but like to simplify it really well, Bank of Canada's policy is to keep inflation around 2%.
Right.
Like, their real inflation is around 2%. But if we take out 2016 to 2025 of the Canadian real estate market, and I looked at Windsor Essex from 2005 to 2015, wasn't uncommon to see 4% or a 5% increase on an annualized basis. So inflation's 2, real assets inflating at 4.
Right.
Well, then why wouldn't I have debt on those things and have more of those things as long as I can get rent to cover that? And so similarly, you're looking at dividends and going, well, now the dividend payment is the rent payment that services the cost of the interest.
Right.
And if I'm making money on the spread, then great.
Exactly. And then the growth is just a bonus.
What does the word or the words negative real interest rates mean?
Well, so in other words, if your interest rate is, say, at 1% and your inflation is at 2%, well, you're actually at a negative. So you're at a negative 1% growth because your inflation is higher than your return.
Yeah.
of 1%. So, and this was very common. Once we get back down to the bond yields have to come down. And that's really where mortgage rates are priced. They're not priced at the Bank of Canada rate unless it's a variable rate. So your bond rates have to come down, and when the bond rates come down, that's when you're going to see a lot of your GICs coming down. And when the GICs are coming down and you're earning 1%, and your inflation is, even if the Bank of Canada holds at 2 or 2.5, then you have negative. You're losing to inflation.
Yeah. Okay, that's a lot. So I appreciate all of this. Anything that you want to leave the audience with before we end it?
Well, I think that if I step back, and it's once again not to keep reiterating, but that one lesson in life is other people's money, and as long as you have an asset is an asset, has to earn income, and if you're borrowing to go buy an asset that's going to create money, and your delta I, your change in interest rates to what you borrow to what you can return at. I mean, it's to me, that is the true definition of wealth creation.
Love it. Well, thank you so much for sharing your whole story with us and explaining your investing concepts with us, or strategies, I should probably say. They're not concepts, they're proven. And I hope everybody else benefited from that. Thank you so much, Ed. Really appreciate it.
It was fun. Thank you, Cody.
Thanks for listening to the show, folks. Please keep in mind that this show is not offering legal, financial, or accounting advice, but rather opinions and experiences in the world of real estate from the host and the guests. If you're enjoying the show, please rate, review, and share with your friends and colleagues. And if you think that there's someone that needs to be on this show, please feel free to connect them with me. Or if there's a topic that should be discussed, feel free to let me know. Thank you so much, and bye for now.